So the first thing that gold and silver investors need to understand is that while cutting rates will strengthen the case for gold and silver measurably, there will be competition for the marginal dollars. So some of the speculative capital that we would have hoped went into the gold and silver market will almost certainly go into small and large tech. I think it is important for gold and silver speculators to understand.
Unlock the mysteries of the miner's paradise with Rick Rule, where the development stage unveils hidden potential for patient investors. Explore the intriguing market reactions and the art of turning boredom into profit. Join us as we navigate the intricate landscapes of the second bottom of the Lassonde curve, revealing the untapped gold mine overlooked by many. A journey where patience reigns supreme and strategic insight fuels unprecedented gains. So don't skip the video. Let's listen to Rick Rule again.
Let me back up. The development stage is described as the boring phase in the Lassonde curve, when the press releases go away from tonnage and grade, and you're talking about securing permits. You're talking about how many yards of concrete you've poured. The stuff that absolutely drives speculators crazy in a negative sense. The consequence of that is that it is probably the most undervalued sector relative to risk in mining. But you have to understand how money is made in the sector. It is not uncommon when a company goes through the boring phase and attains on time, on budget completion. If they do, at nameplate capacity, it's not unusual for the stocks to double. It's not unusual for companies to be taken over at that junction once they've been de-risked. So understanding how value is created, understanding how the process works, understanding the correct intelligent financial stack is critical to, I would say, participating in a sector that right now is, from my point of view, the most undervalued part of the value creation chain in mining. Silvercrest is a wonderful example, but what you say is true. The front end of the Lassonde curve, after a discovery, is the province of retail investors, high net worth family offices, and specialist funds. The really big money, the mutual funds and the generalist investors, the institutional investors, come into a company after they've attained nameplate capacity. There is an arbitrage between the point in time when the retail investors are getting bored and the big money is getting interested, where although the risk is declining substantially, the share price often declines too. And it's precisely taking advantage of that anomaly, the handoff from the individual investor to the mutual fund and institutional investor. Well, the market's always reflective and reactive, and the market's reaction will change over time. So a few comments to what you just said. When you say that the Dow hit an all-time high, that's in nominal dollar terms. It didn't in real dollar terms. And when people say that gold hit a new all-time high, it didn't. It hit a new all-time high in nominal value terms, not inflation-adjusted terms. So it's important to note that the real economic extent of the rally is likely overstated in the sense that we are using nominal rather than real values, which means that if the Fed is good to its word, that there's a lot of reaction to come, that the game isn't over. I would caution listeners from imputing too much near-term relevance to what they've seen. I've seen all kinds of social media presence about the fact that gold is now, on the track to the stars, and silver isn't going to go through the roof, but it's going to go all the way to the moon. Ridiculous stuff like that. A few comments. First of all, the Fed has been known to lie. And I believe that Mr. Powell is more concerned about inflation than he lets on, given the fiscal irresponsibility of Congress. He's under extraordinary political pressure, but to the extent that he can jawbone lower interest rates without delivering them, to the extent that he can restore confidence to housing markets and bond markets without actually cutting rates, I think he would prefer to do that. Okay. I don't think he's going to be able to do that. I think he actually is going to have to cut rates. And if he cut rates, that'll do some interesting things. It'll provide immediate relief to the bond market. Rising interest rates kill long bonds. and the long bond market has been killed in a way that's very familiar to gold and silver speculators. Cutting rates will also do amazing things in the near term to the stock market. So the first thing that gold and silver investors need to understand is that while cutting rates will strengthen the case for gold and silver measurably, there will be competition for the marginal dollars. An example might be that a lower cost of capital really favors the technology business, which is a huge consumer of capital. So some of the speculative capital that we would have hoped went into the gold and silver market will almost certainly go into small and large tech. I think that's true. Looking longer term, however, I think it is important for gold and silver speculators to understand that real moves in precious metals prices occur as a consequence of a lack of faith in the maintenance of purchasing power in fiat currencies, as we've talked about so much. So let's look at the arithmetic one more time. Too many of your listeners conflate the CPI with inflation. The CPI is not a cost of living index. It's a constructed index. It's hedonistically adjusted, which means that the big thinkers decide what the actual value of your house or your apartment or your computer is. More problematically, the CPI does not include tax. When I do a thought experiment and I look at the value of my savings in US dollar terms relative to the goods and services that I purchase, including those like government that I'm forced to purchase, what I learn is that the deterioration of my purchasing power is humming along at about 7% compounded, not 2.6. Here's the rub for gold and silver. If you believe, as I do, that the deterioration of the purchasing power of the US dollar will continue unabated for a fairly long time, and your savings are now paying you 3.5% as a consequence of rate hikes, what that means is that you're being paid 3.5% in a currency that's depreciating by 7% compounded. This absolute guarantee that you will lose purchasing power will certainly diminish your confidence in the purchasing power, and I would suspect will help gold or silver. Listeners with a sense of history will perhaps remember back to the decade of the 1970s, where the lessons around inflation, the lessons around government spending, took 3 or 4 years to take hold. The popular culture didn't pay attention to the gold price at all in the move from $35 to $200. And in fact, after that move, when the Fed raised interest rates, the gold price fell in the middle part of that decade from $200 to $100. It wasn't until early 1976 where the Fed really blinked that gold really truly got on the horse and went from $100 to $850. The point of reciting this history is it would be a mistake for your listeners to believe that as a consequence of the Fed announcing its intention to pivot, that the gold price, the silver price, and the prices of gold and silver equities immediately skyrocketed, or to believe that all of the money, which might logically be expected to come into gold and silver, will. There has been 40 years of experience which suggests that the best domicile for capital in a market like this is technology, and it will certainly siphon off some of the speculative capital around gold or silver. That notwithstanding, I continue to own gold, not because I think that the Fed's action might take the price from $2,000 to $2,400, but rather because of the ongoing deterioration of the US dollar. I think perhaps taking the gold price to $8,000 or $9,000 or $10,000. Is it going to happen? I don't know. Is it going to happen soon? Almost definitely not. Is it a contingency worth insuring against? Absolutely, positively, but be patient. Don't expect that your dreams of avarice are going to be fulfilled in calendar 2024.
As we conclude this exploration into the depths of mining investments and the intricate rhythms of market reactions, remember that the journey to sustainable wealth is paved with patience and astute strategies. Thank you for joining us. Stay tuned for more invaluable insights, and remember, in the world of investing, Patience truly is the key to unlocking enduring prosperity. Until next time, please like, share, and subscribe to our channel. Thanks again. See you tomorrow.